David Burrows of Barometer has brought with him 3 fresh top picks, and we've been talking a lot about wanting to be exposed to the consumer, to the U.S. consumer. I guess you don't get any more exposed than Starbucks.
No, it's funny, early in the quarter, people got concerned when Tiffany guided lower, and I'm not sure why they thought saving $50 or $80 on gas meant you were going to buy $10,000 baubles.
Right.
But you will spend money on a cappuccino, and Starbucks has done a wonderful job managing their brand. They've got multiple moving parts that help them build on their profitability. Their dividend has grown 25% a year over the last 3 years. You've got a strengthening consumer on the back of weak oil prices. They have a wonderful loyalty program. People loaded up 19% more money last year on their mobile devices than they did the year before. They've got Tivana, which is offering some growth in the model. Their same-store sales came in stronger than expected in the most recent earnings period. I think that this is a great way to focus on the consumer. And technically, the stock just broke out a couple of days ago from a nice big base. So I think that the measurement is much higher from here. Yeah,
new 52-week high. Still, it seems like the street's a little lagging as far as where it sees it 12 months out. It's at $88 today. Where do you see it in a year's time?
Listen, I would say that there is a significant move in front of the stock. We think that the consumer sector is going to lead through the course of this year, and this is one of the leading stocks in the group.
Top pick number 2, Walt Disney. Set aside concerns about measles outbreak at the Disneyland attractions.
Look, again, the first place people spend money when they have more is on leisure and travel. We had a client come back from Disney in early December, having been told at the gate the park was full. So their parks are doing remarkably well. They've got 2 big movie franchise rolling out this year, the Avengers, and you've got Star Wars coming. They seem to be able to monetize these properties extremely well. There is all kinds of doors opening as outlets for media, so their content is in great demand. And again, the stock is performing extremely well in a group that's performing extremely well. And it's a big focus on U.S. domestic economy. Finally, China, they're going to open Shanghai this upcoming year, new theme park. And, the Chinese are working at building consumer services and consumer demand. I think that this company's firing on all cylinders.
Top pick number 3 is a company that we thought we would see a lot of the Canadian companies get involved with. American Tower. They don't give you your cellular service. They just got the poles up.
That's right. This is a REIT that owns cell towers, and we've talked about this one many times over the past few years. About 65% of the revenue comes from North America. So it's fairly domestically focused, although they do have Latin America and they do have India, they do have Germany. This is a company that costs them almost nothing to add new capacity. When their customers, the service providers, want to add more gear because there's growth in demand for bandwidth, which of course we know there is, they just simply put more gear up on the same tower. There's very little by way of capital investment in this business. They've grown their dividend this year alone 27%. You can expect to continue to see very strong dividend growth. Their payout ratio is very low, meaning that there's lots of earnings that they can pay out. And there's growth in this. So the world is looking for long life assets that can provide a dividend that will grow. In a world of almost negative interest rates around the world, you should be looking for dividend growth because money will slowly get reallocated to equities looking for this type of holding.
Not worried about it trading 49 times earnings?
This is a very predictable asset with long contracts. So you will pay a higher multiple for that. Would you rather own this yield or a treasury bond at a 1.8% yield that will not grow for sure? I think this one is more interesting.
David, always great having you with us. Thank you for coming back.
Thanks for having me, Michael.
David Burrows has been our guest, President and Chief Investment Officer, Strategist at Barometer Capital Management. If you missed any part of the program, you can go to bnn.ca to get the replay. And as always, please consult a qualified financial advisor before making any investment decisions. I'm Michael Hainsworth, in for Mark Bunting. If the penicillin's kicked in, he'll be back tomorrow night. Otherwise, I'll see you soon. Have a great night.